Hello everybody. Welcome to Dvestments Options 101 for educational purposes only. I'm going to start off with my disclaimer, just letting you know that this is education, teaching you about the stock market and options trading. Okay, Dvestments LLC does not assume any liability for any trades that you make. Investing can be a very dangerous venture, and it is you who must assume the entire cost and risk involved in all your investment decisions. And again, I say Dvestments LLC does not assume any liability. A little bit of stock market history. Stock market trading can be traced back to over 200 years ago. The colonial government financed the war by selling bonds and government notes, promising to pay out a profit at a later date. We still sell bonds today. We still sell instruments that you invest in today, and they pay out a higher price later on. A CD, different instruments. Okay. Around that same time, private banks started to issue stocks or shares of a company to raise money. In 1792, the New York Stock Exchange was formed. 24 merchants met daily to trade stocks and bonds. The New York Stock Exchange consisted of very large, well-established companies. Later, smaller companies were added and other exchanges were formed, such as the American Exchange and the NASDAQ. In 1934, the SEC was formed. This is a regulatory agency. They control, what's done on the stock market. They control companies and how they, what information they need in order to become to trade on the New York Stock Exchange or the NASDAQ or whatever exchange they're trying to trade on. Millions of dollars are traded daily on the stock market. It opens at 9:30 a.m. and it closes at 4 o'clock p.m. So what is an option? An option is the right, not the obligation, to buy or share or sell shares of stock at a specified price on or before a specified date. So when we start talking about options, we talk about contracts, not shares. So essentially, an option contract is like leasing a certain amount of shares of stock for a certain period of time to make a profit. And in this case, one contract controls 100 shares of stock. So instead of you purchasing those 100 shares of stock, you lease them, hold on to them for as long as you want, and then you sell them for a profit or a minimum loss. So one contract equals 100 shares of stock. 2 contracts equal 200 shares of stock. 3 contracts equal 300 shares of stock, and so on and so on. $1 in the option world is equal to $100. We have 2 types of options. We have a call option, and that you buy that when the stock is going up, and a put option you buy when the stock is going down. We can make money on both sides of the stock market, whether it's, whether the stock is going up or whether the stock is going down. It really doesn't make a difference because you can make money on both sides and in both directions. Why do we buy an option? We buy an option because it's cheaper. Okay? We can control more shares of stock with one contract. So an option would be $1 a share. Okay, those 100 shares will cost you $100. Or I'm sorry, or that one contract will cost you $100. If you bought that same 100 shares of stock outright at $10 a share, that same 100 shares will cost you $1,000. So again, options are cheaper. I'd rather spend $100 versus $1,000. Options expire. Monthly options expire the third Friday of every month, and weekly options expire every Friday of every week. Okay, options expire and they get executed, meaning that you are obligated to buy however many shares of stock that you purchased with each contract. So if you purchase one contract, you're going to be obligated to buy that 100 shares of stock. If you bought two contracts, you're going to be obligated to buy 200 shares of stock. Okay? So it's important that you sell your option timely so that they don't expire and you're not obligated to purchase the shares of stock that you were just leasing. Okay? You do not hold options until they expire. Holding an option until it expires, it's either going to expire worthless, or if it expires with a profit, you're going to be obligated to purchase those shares of stock, as I said earlier. Do not buy options that expire in less than 6 weeks if you are purchasing monthly options. If you're purchasing weekly options, then you trade a little bit different and the rules are a little bit different. But if you're purchasing monthly options, you don't want to purchase an option that's going to expire in less than 6 weeks. We have 3 types of markets. You have a bullish market where the stock is going up or the market itself is going up. People are buying. You have a bearish market when the stocks are going down or the entire market is going down and people are selling. You have a neutral market when prices are going sideways and they're fluctuating in between 2 prices. So they may be fluctuating between, they may go up to $28 and then the stock will go down, say, to $23. And once it hits $23 or somewhere in that range, then it bounces back up and it goes back up to $28 or somewhere along in that range. But it's not breaking out of that range between 23 and 28. So it's going sideways. So let's just see how this works. So let's say you have $200 in your brokerage account and you purchase a 85-cent option, which is one contract, and it will cost you 85 cents. So that's 100 shares, and that's roughly going to be $85 for each contract. Okay. With your $200, you can purchase 2 contracts. That's going to be roughly $170 plus your commission. You always have to pay commission. You have to pay commission when you purchase your contracts, and you have to pay commissions when you sell your contracts back. Okay. So you purchased your contracts for 85 cents per contract, and you sell your 2 contracts for $1.10. That's roughly $220 for both contracts. So if you do 220 minus the 170, which you initially spent, that gives you roughly about $50 profit. Okay, minus the commissions. Like I said, you always pay commission. So we're just going to use raw dollars, not not counting in commission. That's roughly 29% profit margin for the day. Now, you can't get 29% a day by depositing that same $200 into a checking or a savings account. But you can do that in the stock market very easily. So the underlying stock that you bought, and you were able to do all of this with the underlying stock moving only about $1. So if the stock was, let's say the stock was $90 a share at the time when you purchased it, and the stock went up to $91, you could have made that 25 cents, because that's all it went up. It went from, your contract went from 85 to $1.10. So it went up 25 cents. You could have made that 25 cents on your contract, pocketed that $50, with that stock roughly moving only $1. So it went from $90 to $91, just using it as an example. And you were able to make $50 with your option only moving 25 cents. That's just a simple example with $200 in your brokerage account, what you can do. Because that's the first question everybody always asks me. Well, how much money do you need? So I just roughly, use $200 as an example. You can always put more money into your brokerage account, or you can start off with less money. But again, that's just a simple, example of how much money you can make in the market in one day. So, Dvestments offers private classes, group classes. Also, their marketing options updates daily. And you can email me for prices and availability. Again, it's dvestments@gmail.com. And you can email me for private classes, group classes, marketing option updates daily. And that's all I have for today. Tune in again for another Dvestments update. We'll talk soon.